following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and welcome back to Volatility Views, your weekly source for all things volatility. My name is Mark Longo from the optionsinsider.com, as well as the Options Insider Radio Network. And I want to encourage all of our listeners here at the top of the show, if you want to follow along with any of the topics we're discussing on the program today, or indeed go check out any of our archived episodes of the program, you can do so right over there at theoptionsinsider.com. You can also find all of our show notes for our previous episodes and for this episode as well, so you can follow along with some of the links and notes that we have there. Of course, you can also sound off for our mailbag there as well. So a lot of good things you can do on the site to help you follow along with the show and even become a part of it. And of course, joining me on the Volatility Views panel today, starting off with the degenerate premium buyer amongst us. Oh wait, I mean seller. How did I get that wrong? Of course,
you scared me.
None other than Don Schlesinger, the major domo over there at the Volatility Exchange. Don, welcome back to the program, sir.
Always good to be here. We had a fairly calm week, but looking forward to a rather interesting guest and a departure from our norm. So we'll be interested and focused on what he's got to say.
Yes, we're taking a little bit of a left turn on today's show to bring listeners some of the interesting discussion from the world of commodities and commodity options with our guest, Rob Heineman. He's a commodity broker over there at the Board of Trade, talking about some of the ag options, some of the ag vol we're seeing going on out there right now. Actually, today is the day of the crop report. Some great timing for him to join us on the show today. And of course, last but certainly not least, we are also joined by Mark Sebastian from OptionPit.com. Mark, welcome back to the program, sir.
Hey, what's going on? How's everybody doing?
And I hear you're suffering the same ill effects from the same flu or whatever it is going on in Chicago that I am, sir.
That's right. I'm getting done here, and then I'm going to go to the doctor's office.
Yes, sounds good. So if Mark and I sound a little bit perhaps deeper or perhaps more nasal than usual, or are coughing quite a bit on the show.
Could you sound any more deep, Mark?
I don't know.
That's my question.
I can get my Barry White mode if I really get sick.
Mm-hmm.
We'll save that for another day. I don't know if the listeners are ready for that yet. All right, listeners, with the team assembled, we're going to dive right into our volatility review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the show where we dive into the week's worth of action from a volatility perspective. And Don kind of teased it at the top of the show. Not a whole heck of a lot going on from a volatility perspective. There we saw the bulk of the action over the past week when volatility came off in record amounts in most of the major indices. This past week, we saw really a lot of fluctuations around those same levels for the most part, which is, I don't think really came as a shock to anyone, particularly listeners of this program, which is, of course, exactly what we predicted on our last show. But Don, since you started off on the intro, why don't we start you off here as well? I know it wasn't exactly the most scintillating week from a NASDAQ vol perspective, but did anything in particular catch your eye out there?
Well, there's not a whole lot to say, and it was a quiet week, and we're talking about probably more noise than anything meaningful to discuss in terms of a trend. But it was mildly interesting to note that NASDAQ actually came off about a half a point in terms of actual market volatility or realized volatility. We were up at about 18.2, and currently looking at about 1763. And if there is a somewhat interesting fact to point out, it's that S&P actually went in the other direction. Again, maybe just noise and normal kinds of fluctuations, but S&P that was just about 14 even for 21-day historical vol as of this time on last week's show is actually looking at about 14.4 right now. So if you looked at it as a spread, you actually had almost 1 point change, a narrowing of that NASDAQ minus S&P realized volatility spread. Had been sitting at 4.14 last week and has narrowed to 3.24 as of the recording of the show today, which is about 1 o'clock Central Time on Friday afternoon. So again, possibly just random noise, if you like, in what was a rather calm week.
Mark, was that your take as well from an S&P/VIX perspective?
Yeah, I mean, I think I mentioned this yesterday. The VIX curve is basically screaming that earnings season is not going to matter to the major indexes, and the debt ceiling is what matters in terms of the major index move. And we could just have this slow creep higher between now and basically Fed futures expiration, which is kind of the end of February. Basically, people will start worrying about the debt ceiling in about 6 weeks.
That seems to be exactly what the market is indicating. They have kind of written off most of the near-term events of Alcoa and any of the other early earnings or any indication. They're not exactly wrong. Hasn't been exactly a blockbuster earnings season yet. Of course, it just started.
By the way, I can't believe those Alcoa people lied to you about the tinfoil.
Well, that's an ongoing debate for another show, sir. But yes, interesting. Don, we had an ongoing raging debate yesterday on one of our programs about whether the shiny side or the matte side of the tinfoil is the proper side to attach to the food, and why that may be. Mark suggested there was some reason to use one over the other. I thought that was highly dubious. And,
well, I don't know if I get a vote or not, but typically I put the food on the dull side and then wrap it so that the shiny is outside.
There
I don't
you go.
know if that puts
That's
me
pretty much what everyone does.
or not aesthetically, but if I get to cast the vote, that's the way I do it.
That's the way I came down as well. Even though the truth is there's no difference. Even though Mark was determined that the shiny side had some magical non-stick properties from the Keebler elves that they coated on there.
Well, that's just that buy-sell premium differential,
It's the age-old trade-off, shiny side versus dull side. And you can tell, listeners, it was kind of a slow week in vol when we're debating the shiny side of tinfoil.
Yeah, and next we're going to go into whether the toilet paper hangs over the roll or goes underneath,
yes.
Right?
All these great pending mysteries of life settled here once and for all on Volatility Views. But actually, listeners, we do have a great guest lined up for you. So we're going to close out our Volatility Review segment and dive right into our Volatility Viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and welcome to the Volatility Viewpoint segment. This is, of course, the portion of the show where we welcome on a guest from the world of volatility and volatility trading and proceed to pick their brains for the benefit of you, the listener. And today's guest is Rob Heineman. He is a commodities broker over there at the Board of Trade. Rob, welcome to the program.
Well, thank you. Thank you. It's good to be on the program.
And, you're a little bit of a departure for us, so it should be kind of interesting because we typically focus on the realm of equity and index volatility, but we like to segue into commodity vol whenever possible. So this will be an interesting little segue for our audience. But before we do that, why don't we dial it back a bit and give you an opportunity to tell our audience a little bit of an overview of your background in the options and futures markets.
All right. I work for a company called Futures International. We are basically, futures and option brokers, but obviously since we're on the floor, it's all options because the futures are on the screen. I've been on the Board of Trade since 2001. I started in options in 2003. Just kind of, I didn't know that that's what I wanted to do, but the computer drove me out of the brokerage and the bean pit. And that was my intro. And I went from there. I was fascinated with the ball game. There's no dull moment. There's always something to do, and there's always something to trade with less risk and way to lay off and all the strategy. So I thought it was a great time. We probably, it's not, defined, but we are probably the biggest options brokerage, independent options brokerage on this Board of Trade floor, with all pits covered. We really go for larger institutional clients and funds and banks and all that good stuff.
And I appreciate you joining us today on a rather busy today. You had one of your crop reports today. So anything interesting going on from a volatility perspective or from a paper flow perspective that you're seeing out there in the wake of or perhaps leading up to that report?
Well, there's always the vol typically gets bid up before a report, of course, because there's uncertainty. But depending on the blow of the report, it depends on whether that stays or whether it just gets slaughtered. In this case, it's been both. This is the first time we've had an 11 o'clock report. Usually it's in the 7:30 a.m. realm. So it was kind of you had an hour and a half of, floor trade where we didn't know what the report was going to do. Surprisingly, the vol did get bid up in that point. We had, some of the front month Feb that was up, up to 27, 29% in some of the pits. And then the report came out, and of course the report's bullish, and then the futures, crank up, which is funny. And then of course they come back down, but all just got, tanked. So you had a 29, 27. I think the vol and the Feb vol in the wheat pit went all the way down to 21% from 29. So you had an 8% swing. Now they're bidding that back up. So it's not for the faint of heart.
No, definitely not.
These kind of deals.
Definitely not. Let's walk us through that a little bit too, because it's kind of interesting. We often talk on this program about the ramp up we see in volatility going into things like earnings announcements or non-farm payrolls, things like that typically impact a lot of the financials and the indexes, and also the equity options. And of course, we also talk quite a bit on this program about tail risk, which in the equity world is the downside. But of course, you're in the commodity realm. The vol picture is almost the inverse there. The fear, the risk is to the upside. So going into a report like this, going into a number like this, what's the typical paper flow you see coming in? You say the vol gets bid up. Is that concentrated in one portion of the skew? You see a lot of people coming in and loading up on upside calls and verticals in the different products going into the report, or is there a smattering of paper across the board? What do you typically see going into a number like this?
You'll typically see straddles, and that's really how we dictate where the vol is. We produce, our company does, straddle runs, about every half hour or so, just to keep everybody updated of what's going on. And I think that's really the evaluation of where the vol is at and where we're trading. It's going to be an at-the-money straddle. I haven't seen, unless the paper is completely sure, then you're going to see upside calls or, downside puts getting bid up. And that will sometimes raise or lower the vol depending on, obviously the delta of that strike, or it will just affect the wings. You have, especially in the bean option pit right now, where it's a very difficult trade when your skews are flopping around. So you can be in a 20 and 22% vol range, but your skew, your call skew will be, a plus 50 and then down to even and then maybe a negative 10. So the wings can really pose huge risks as you're trying to just lay off on some insurance, and then it's in your face.
Rob, I'm kind of interested in what you're saying there, because following up on Mark's question, as you may be aware, even though it isn't your area, in the equity indices, we have this skew that is pronounced to the downside, where the demand is for the below the market or the out of the money puts, and that bids up the implied volatilities. And sometimes people buying that want to offset some of the cost by selling calls up above the current market, and therefore that depresses those implied volatilities. So you're probably familiar, at least, with the concept of the shape of the equity volatility skew. Now, if I'm hearing you correctly, obviously that is different in commodities, but in fact, you're saying it may jump around a lot more than it does in equity. And so I'd kind of be interested in what the typical or classical type of shape of that skew might be? Is it a mirror image of equities? Is it two-sided like FX, where out of the monies in both directions are actually bid up? And does it vary from one commodity or agricultural product to the other? So I guess I've asked a multi-part question, but I'm very interested in the answer.
Okay, well, typically we call them wings. The skew is positive on both sides. So you have, let's say your vol is 22%. Your 20 delta may be 24%, and on either side, depending on what's bid up. And I understand the equity, how it would be bid up on maybe like the put side. So your put slope would be higher than the call slope. That happens all the time. You'll see, but ours seems to be backwards in the fact that as we're going up, you'll see sometimes the call slope flatten and the put slope go, which it sometimes just doesn't seem like it's supposed to be that way. You think that traveling up that people would want to be buying the calls, and therefore that slope would raise, but sometimes that'll flatten out, and that's where the uncertainty really lies on the wings, and you can get touched on those. At the same point, you can use that to your advantage. You'll see typically paper will pick a strike, and that strike will dictate what that skew is going to do. And, it'll be a friendly strike of, let's say in the beans, it's a $14 put or a $14 call, $14.50 call or a $15 call, and they'll come in and they'll just go at it. You'll see a fund just buy them and buy them and buy them. And then that will, once the open interest is in that strike, that's going to dictate from then on, those skews, because everyone's watching that strike because that's where the open interest is. And that's where you can get in and get out.
And so it doesn't necessarily have to be at the money at that moment. It's simply where the paper is and where the interest lies, and people focus on that particular area of the skew and then kind of go from there as to whether or not you're increasing or decreasing as you go up and down.
That's correct. Our paper dictates our trade. That's just the way it is.
Now, this is typical throughout all the various commodities that you trade. It's a similar principle. What are the actual commodities, the various, pits or different commodities that you're involved with?
We're involved with the bean options, corn options, wheat options. I'm over in the soybean meal, soybean oil options. I deal with crush and crush options, and also oil share. We have people over in the livestock, the live cattle, and the hog options. And yes, they all trade similar, where the paper really dictates where the vol is and what's going on with the skew.
That's very, very interesting. And I actually learned something because, I kind of thought like Mark that it was sort of the mirror image of equities, but you're kind of indicating that although it can flop around and change, it's more like a U-shaped type of curve that we sometimes see in FX, where the extreme out of the monies, as you said, the 20 delta, whether it's calls or puts, each could be bid up, whether it's symmetrical or not, but that you would have that upturn, like a classical smile.
Yes, I would say, upwards into the 90 percentile do we have the smile. I think that's a very typical skew. When you see it flatten out, I think is very rare. In the bean options, of all the years I was over there, I only saw it a couple times. But when that happens, since it's rare, these are the things we look for. And I'm going to say, hey, look at this skew. You should probably start picking these up, because you can make money even if the market continues to go up. As soon as that slope corrects, you've made a profit. But yes, we trade. So I'm guessing again, it's similar to the FX market where it is a smile, and I would say that 90% of the time that it's like that.
Yeah, Rob. One quick question for me. This is Mark Sebastian. One of the things that's unique about the beans, and I think a lot of beans and corn and some of the different ags, I think people will be surprised at how much cross-market trading goes on between soy meal, corn meal, and all the different ags. Can you briefly talk about some of the volatility arbitrage trades you'll see between the different commodities and commodity products?
Sure. We, again, as brokerage, we like to make aware to our customers of what's going on, and we really look for the differences between that. So let's say corn vol is extremely high, and it has been. We had a crazy year. We had
summer was nuts, right?
Yeah, we had a crazy drought, and we had the ethanol mandate, which was questionable whether it would continue, whether they were going to stop it, and so you looked really, these vols in the front month corn were up in the 30 percentile, which is rare. So we would say, okay, if you want to get in on this, why don't you could buy the 30, but you can sell something that's not moving around for protection. Let's say bean oil, because there's enough bean oil for forever right now. And although it was a low, 20% or maybe 19%, it wasn't really going anywhere. So, you can lay off because, in the commodity markets with our options, we trade Greeks, and, our positions are you're borrowing or lending basically. So if you're long premium, you're paying to hold that position. So you're paying theta, and then, obviously you're long the gamma, so the moves are going to help you, and obviously opposite if you're short. So a lot of these guys don't want to pay to hold the position. So if you can lay off in another commodity that's not as risky, you can scratch that theta and just, hold that long, or sell it, if you think that corn's going to come back down. You'll see a lot of that in the bean and the bean meal and the bean oil, with the soybean, because the soybean pit sometimes really dictates what the soybean meal does. So if you'll see, the soybean meal vol start getting, bid up, you'll see guys coming into the meal and try to get a part of that before it catches up to the beans. And you'll have those kind of spreads. You'll have oil share spreads where people will, sell the oil calls and buy the meal calls. All of these kind of things are stuff we look at. And I think that's what's really fun about the commodities market is there's always something. There's always something that's not right, or there's always something that poses an opportunity or to think about, to say, okay, well, wow, last year price was here and now it's here, but the volatility is over here. And it really, I think that it shows a lot of opportunity to make a lot of money and at the same point reduce risk, and that's really kind of what we try to do, so no one's truly exposed to get really hurt, because that can happen very quickly in our industry.
Last question, and then we'll let you get back to business. Do you see any trading between some of the we deal a lot in equities, so one of the things I'd be interested, do you see a lot of people arbing out some of those equity ETFs like DBA, MU, corn, soybean, against some of the commodity trading that you'll see, or is that done primarily upstairs?
Honestly, I don't know if they do or not. I have not heard of anybody using those kind of ETFs to leverage against things. I've heard them spec it. They'll say, oh, let's look at the moves down or whatever. I don't know. I don't know if my funds are doing that somewhere else.
Okay.
So I really can't honestly answer that question, because it's an equity side. So that would be, off the floor and basically their business of how they're reducing risk.
Right.
But Rob, I'm kind of interested, going back to the previous discussion and the fact that, you're trying to lay off risk and do spreads to us, and we're not expert in the agricultural markets. You would name soybean and corn and beans, and we might think that there could be some connection or correlation or relationship among them, but these are all different and separate commodities to us, and yet you've mentioned of having exposure in one and trying to offset it in the other. So I'm kind of interested in what these pairs may be, or the correlations or the interrelationships as to, when you're long one, how you decide what the right layoff or short is on the other one, whether it's a pairwise type of thing that you naturally look for as a hedge, or whether that itself can vary. So can you talk to us a little bit about that?
Yeah, I'm just, it all varies. The relationship between bean, corn, and wheat is basically what's planted. Where else do they grow? We look at South America, who's going to look to have a record year in the corn and soybean market, and that's why the price has diminished so much over the last few months. So you're going to look at, okay, if you're looking at scale and what you think the farmers are going to come in here and plant. If the price of beans goes down to a certain point, the farmers don't think it's going to be profitable, and they're going to plant more corn because it's higher base because of the ethanol credit that came through and whatever. So it's the relationships are always in flux. They are always changing. You could think that wheat is a great buy, and so you're going to sell corn against it. We see a lot of the corn wheat spreads. I think that I see more of that than I do like a bean corn spread. But that will switch also. So, and that could change week by week. These aren't really, most of the time, not very long-term positions that these guys hold unless they're very sure, unless you're looking at delivery. There's so many different aspects to the ag market. When you have houses like ADM and Cargill who will take a position as maybe it looks like a spec position, but they'll take delivery on it. If it's not working out for them, they'll hold it and take delivery. So they're going to get the physical after the expiration. So there's so many dynamics that it's really hard to explain of like really what is typical, because there really isn't anything that is typical, especially in these markets where, again, we haven't had any snow. We haven't had any hydration in the plains at all. And, coming off of a huge drought year, if we don't get it, then you're looking into another drought year. And, we look back to the 1930s where we've had, they had 4 years of drought. So these all become factors. And just like in your equity markets, we chart it out. We look at the historic, we look at yields, we look, the yields historically and planting historically, and talk to the farmers and see what they want to do. We talk to the grain elevators and see what is the stuff moving? What is the bid? What's the spot price? What's the basis? The Mississippi being low is hurting barge traffic. How does that affect? There's so many different aspects of what's going on.
I'll bet you guys know a great deal more about the environment and the typical weather forecast than your run-of-the-mill weatherman does.
Yeah, your local weather guy.
Yeah, no, we get it's funny, even in the wintertime, I get probably 4 or 5 emails an hour from different sources on weather. And I get weather from India to South America to our plains. And we get overall percentages of drought or precipitation and that sort of thing, to always keep an eye on that.
There's one other question, Rob. From everything that you've just said, and you'll correct me if I'm wrong, our idea very often in terms of equity markets for market makers in particular is not really taking too much in the way of directional positions and doing a great deal of scalping, delta neutral trading, trying to buy bids, sell offers, the typical way that market makers put bread on the table. But I'm getting a sense from you that perhaps in your line, there's a little bit more in the way of directional trading and taking some viewpoints, or is that not the case?
Well, from a brokerage standpoint, yes, we look for directional trade and we look for any opportunity that we think is off. From a local aspect, we're fighting the screen. We're the last of the Mohicans down there. So we're looking at 50-50, where the locals are trading 50% of the volume and screen's taking the other half. We do a lot of delta neutral trades where people just want to take positions. The locals themselves are the same way. They don't really directional trade. They want to trade as flat as possible. They're looking for their edge and they're looking to flatten out. So you'll see them lean on other paper and stuff like that in the pit to, take the risk off. They do not want to show risk. They don't spec whether it's going to go higher or not. Most of them, don't really care as long as they're protected. And it's again, I don't think the dynamic of that kind of local has changed at all. You're still going to get your butterflies. You're still going to get your condors, and those will be traded, sometimes at value, just so they can get off, some of their risk, upside or downside.
Rob, one last question before we have to wrap up here. I'm going to go back to something you touched on when we first started talking about people coming into the pits and buying straddles. That's a narrative we hear time and again on the commodity options side. And it's the polar opposite of what we see on the equity and index options side, where the bulk of the paper flow, the bulk of the customer flow, the bulk of the quote-unquote professionals and the experienced retail all pretty much lean on the premium selling side of the fence. We see almost an inverse of that on the commodity options side, where people show a much greater willingness, and Don, cover your ears, I'm talking about buying premium here, but
all right, I'll do that.
But you see a much greater willingness, or should I say lack of reluctance perhaps, to come in and actually buy premium, even in the weeklies, which is essentially heresy in equity options land. 98% of the paper flow in weeklies is selling in an equity option. In a futures option, short duration product, people will buy them even the last day of their expiration cycle. So that to me has always been fascinating. I'm curious if you see the same preponderance of paper flow buying and premium buying in your products, and if so, what do you attribute that to?
I don't know. I think it's funny that you guys are on the sell side in the equities. I agree. I mean, if you think about it rationally, if 90% of the options expire worthless, why would you not be short? Again, you have the theta. You're paying in, you're taking out. I know a lot of guys that will spell from the short side, and if it goes in their face, they just go home and ride it out. Risk management obviously loves those guys, and they tend not to last long, because once they get hit on a good one, they're looking for another prop house. These guys will long, obviously, because for the gamma, that they think that this is going to really move around. So if you're going to come in with a large position and you really think that these beans are going to whip, or they're going to go limit up or limit down, or you're going to have some major problems, they have no problem buying 25%, 26% vol. And they will come in and they will do it, and you're going to buy 500,000 straddles. The gamma they collect alone, all they have to really move is about 10 cents a day, 15 cents a day for them to be okay if they're hedging properly. Again, if we stay stagnant, they're going to lose. I see it from both sides because there's both angles. I also see where the vol gets to a point, and this is always fun, where it's too cheap to sell and too expensive to buy. And it just hovers and nobody will touch it. And that's where we kind of write down what the market scenario is, where the price is, what time of the year it is. And so for historical reference, we can say, okay, I remember this time last year, nobody would touch this vol. This vol was absolutely fair value. And that's kind of a point of reference to us later to see what's high and what's low, if it's going to self-correct or not. But yeah, I mean, I see both sides. I see long side and I see short side. And that's just all based on where they think this is going to move.
Well, Rob, thank you for that. We want to thank you for taking some time out of your schedule on this busy crop report day to come join us here on Volatility Views. Anything else you want to leave our listeners with before we wrap up here for the day?
No, not really, actually.
No final words of wisdom, buy straddles, sell beans.
Oh, I don't know. This is a very weird time of year. This is a very weird time of year where there's just a ton of uncertainty. I don't know about the weather here. I don't know. Who knows if Argentina's lying? It all depends on what's China. Is China going to import? They're having inflation risks right now on their food. We've seen some cancellation on purchases there. So it's really kind of an in-depth ball game where it's either you're a part of it or you're paying the local. I think in that kind of aspect.
Well said, sir. Thank you again for joining us on the show today. Rob Heineman, again, the commodities broker over at, was it Futures International? Is that what it was?
Futures International.
Great. So Rob Heineman, the commodities broker over at Futures International, thanks for taking some time out of your day to join us here on Volatility Views.
Thank you.
All right, and that's going to do it for our Volatility Viewpoint segment. And now we're going to dive right into our crystal ball segment.
And now we take a look at the crystal ball.
All right, and that sad, indeed melancholy music means it's time for our final segment on the show today, of course, the crystal ball, where we gaze into the murky depths of the future and attempt to divine what the vol gods hold in store for us over the course of the coming week. And I think listeners, if you've been paying attention to the show, this episode, any of our recent episodes, I think you have some idea what we're going to say, but I won't put words in Don or Mark's mouth. I'll let them say it for themselves. Starting off with you, Mr. Schlesinger, what is your prognostication for the future of NASDAQ vol?
I can't get terribly excited here. I'd have to say more of the same being a rather tight range in terms of volatility, and we seem to be seeing levels now that the market is fairly comfortable with. We thought that perhaps, earnings season could add some sort of a boost to volatility, but it's the old axiom of, buy the rumor, sell the news. If people were speculating on higher volatility for the potential of either disappointing earnings or pleasant surprises, you suspect that was done already a couple of weeks ago. And now when you get to the actual reports, and most of them being reasonably anti-climactic, we just see, if anything, the drain on volatility that Mark was referring to a little while ago. So I can't get terribly excited here. I don't know that I want to predict lower, but I kind of want to predict not maybe the best time to be buying time premium and expecting to get any help from rising volatility.
Yeah, if you're talking realized vol, there certainly is none to be found. So
yeah.
You probably have some room to even to go lower from a realized vol perspective. And I think I have a new technical term for what we're in right now. It's the midwinter summer doldrums. You like that? You like that, Don?
We're moving the doldrum period up a little bit.
There are many doldrum periods throughout the trading calendar. This is just the midwinter summer doldrums that we're experiencing right now. So,
fair enough.
So batten down the hatchets for no appreciable vol unless for the next few weeks, unless someone comes and really blows the doors off of it from an earnings perspective, or indeed just surprises everyone to the downside, which there always is that potential in earnings season. But that outlier aside, it doesn't seem to be too much until we get into the teeth of that debt ceiling debate in February and early March. Mr. Sebastian, what say you about the future of S&P vol?
Yeah, same thing as NASDAQ vol. If there's anywhere where there could be some action in the next few weeks, I think it could be precious metals. But that's about it. As NASDAQ goes, so goes the S&P, I say. Or vice versa.
Wise words, sir. Wise words indeed. And I think with that, we're going to close out our crystal ball segment. And that's also going to do it for this episode of Volatility Views. But before we go, I like to check in with my cohorts here, my partners in crime, to see what they have cooking in their respective necks of the woods. Starting off with you, Senor Sebastian. What is coming up in the land of OptionPit.com?
We're going to have a free webinar on Wednesday, the 23rd in the evening. It is going to be on, volatility. We're going to do it on volatility.
Oh, so you've made a determination.
Introduction to volatility.
Okay. I like it. I know the subject was TBD when last we spoke. So volatility, I like it. It's a very very all-encompassing topic. There's a lot to do.
Ubiquitous.
It's almost like you can make a show on that very one subject.
Well, my view is you could.
I'll have to explore that for our radio network going forward. A program on volatility. I'm not sure how that would work. Don, what would you think about a show about volatility?
Sounds like a very good idea. I'd be in favor of that.
We should pursue that. Well, shows aside, what else is coming up in the land of Volex and Volex.us?
We added a couple of interesting papers to our volatility library. I've mentioned this in the past, but I really think that if there are researchers out there or people looking for information from an academic viewpoint or even from the industry practical viewpoint, that I think you'd really be hard-pressed to find any particular site or area where there's a higher concentration of information, scholarly articles, papers, having to do with every conceivable aspect of volatility. And one that we just added a few days ago was a fascinating study, a little bit intense on the mathematics, but when I get papers like that, I like to read the abstract. I like to read the conclusion at the end, just get to the meat of what the paper's about. And it had to do with predicting or forecasting risk premia or risk premiums. So the concept of that spread between implied and realized, what it is historically, how it bounces around, not only how it fluctuates, but how you might actually go about trying to predict whether those kinds of spreads are going to go in one direction or another. So, you find that in the resources section of our pull-down menu. You simply go down to the Volatility Library, and it will be featured as the top article that has been added. We try to add papers on a regular basis as we find interesting topics, and those of you who haven't yet looked at the library, there's a wealth of information there, so I would invite listeners to have a look.
Yes, I'm looking at it right now. I'm actually on the homepage looking at the What's New section, and I see you updated your hedging and options book article with some new equity index data. I think that would interest a lot of our listeners out there. I know we have a lot of listeners in the professional realm who do indeed hedge options vol books on a regular basis. So I think that article, would come in handy for a lot of them.
Well, what we did, and I think is very interesting, is, we started this out quite some time ago, a couple of years when we had our euro-dollar vol contracts listed, and we made the study, try to take all the information from those options and that hedging perspective and tailor make it to an FX study. But of course, as we are swinging into the equity area and anticipating the launch of real vol futures on NASDAQ, S&P, et cetera, we wanted to kind of revamp or redo that article so that it would now be equity based. And so we had a complete new study, complete new simulation using equity options. And I think the findings are very interesting. So you'll find a link to that on our homepage.
There you go, listeners. Check out the What's New section of volex.us to find out all about that paper and much more lurking in the archives over there at volex.us. Speaking of archives, you can, of course, find all the archives for all of the episodes of Volatility Views over at theoptionsinsider.com. While you're there, you can also use our comment system or just shoot us an email, questions@theoptionsinsider.com, or even find us on Twitter or Facebook if you too would like to send in a question for our listener mail segment. We love to hear from you, the listener, and see what's on your mind and perhaps answer some of your pressing questions about volatility. So by all means, surf on over to theoptionsinsider.com and let us know what you're thinking. If it's interesting and fascinating, perhaps we'll read it on the air. But unfortunately, that's going to do it for this episode of Volatility Views. And before we go, as always, all of us here on the Vol Views panel want to thank all of you in the listening audience for downloading and streaming and subscribing to this program and making it such a success. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.